Thank you, Peter. It's with great pleasure we're presenting today at the Income Conference. We love being here. My name's Paul Myliotis. I'm Managing Director of Msquared Capital. I have with me today my good friend and co-founder, Paul Miron. Before we get going, I'd just like to give you this lovely slide we put on all the time that's a disclaimer that's saying we're providing you with general information only, and it shouldn't be construed as advice. So who are we? Well, Msquared Capital provide our investors with the tools and the platform to enable them to choose and construct their own private mortgages. So we're a private credit provider, otherwise known as a non-bank lender. We match borrowers who need money directly with investors who have money. Now, we are a secured lender only. Very importantly, we only do investments that are backed by property, predominantly in Sydney, but also in the eastern seaboard of Australia. So we mentioned that we provide our investors a platform and tools to make their own investment decisions, but what does that actually mean?
Well, look, as opposed to other mortgage funds, we actually run what's called a contributory fund. Now, when we try to explain it, people don't actually understand the actual benefit that actually in doing so. So, Paul, I'll ask you a question. Do you own direct property and shares?
Yes, I do.
Well, what are the actual benefits in doing so? Because you have more control, you have transparency of what you actually own, it's better for risk management as well, and you believe that you'll have a better financial outcome as well. So, as opposed to actually having a pooled fund. So, investing into mortgages is no different at all. You have the same benefits in investing into direct mortgages as you have shares and you have property as well. Why don't I give you a more of a detailed example of how that could work for you? So let's say that someone has $1 million to invest. That person has the ability to create their own diversification by creating an opportunity that has different tenure. So it could be 3 months, 6 months, 9 months, it could be 12 months, it could be 18 months, it could be 2 years. They can also choose the type of investments, which is the security behind it as well. So for example, it could be residential, commercial, industrial. They also can control the gearing. So they might be comfortable of lending 70%, so 50%.
Let's talk turkey, Paul. So what we're saying is you can create your own diversity by choosing different things. So you might have a 3-month loan term with a residential property in New South Wales that is only lending 65% of the value of that asset. Or you could have a 50% loan against a property in Queensland, which was 18 months. So you create your diversity by breaking up your $1 million into multiple different investments.
But more importantly as well is that all of our mortgages and all our opportunities are risk rated. So therefore they have various difference in returns as well. So our returns could be anywhere between 6% all the way up to 8.5%, depending on what type of opportunity you invest in as well. So as an investor, you can control a lot. You can control your returns and the security and the risk.
So there's perception in the marketplace that contributory funds have higher risk. Now, I think we can demonstrate that you can choose your own risk depending on what you can dial it up, you can dial it down, depending on what your actual risk profile is.
And the question is that if you have a pooled fund that only does one very thin or one very narrow type of transaction, let's call it just construction, then it's arguable to say that the risk profile of that is actually higher than actually being able to choose your own.
So what we find, if one sector gets hit, it all gets hit. So if you're doing only industrial assets, for argument's sake, all of that will get hit. So you need to really be careful if you're managing what's actually in that pool. So let's just talk about our track record. So we've never lost $1 of investor capital. We've had no arrears. We've always paid our investor returns on time. Importantly, our chairman, JT, who ran Howard Mortgages over $3 billion, also didn't lose $1 of investor capital. Now, there's a reason why, and that's because of understanding and mitigating risk. And that's what we want to talk to you about today. So before we do that, if you look at one of the biggest pool funds in Australia, their average return across the whole pool is 4%.
That's right. And so if you look at the entire portfolio or the average return of Msquared at all active loans that we have right now, we're returning an average of 8.04% to our investors.
So what we're saying is, with a little bit more effort, you can actually potentially double your return for the same risk.
Absolutely. And so look, it really comes down to understanding risk. So that's what we want to talk a little bit further today. The most successful investors in history have been the ones who've been able to decouple risk and understand it and be able to make their own decisions. So there are essentially two types of risk. One that you can control, which is what we can do internally as a business, and one you can't control, which is a macroeconomic.
So look, let's talk about market risk. That's Paul loves saying macroeconomic. I say market. It's interchangeable. Let's talk about the market risk first and what's affecting our sector and others.
Well, look, one of the most debated economic questions that we have at the moment is inflation. Why is inflation so important? Well, coming out of COVID, we've had supply chain issues, labor shortages, higher energy costs, which are all adding to the inflation story. Now, is inflation transitionary or not? Now, if it's transitionary and if it's just a blip, then there's really nothing to worry about. But the reason why you want to worry about it is that inflation is permanent, that the reserve banks across the world will have to increase interest rates. Now, once they increase interest rates, it will affect all asset classes, being property, shares, and others as well, that we will actually have a downward pressure on those asset classes. Now, just to really elaborate how the mechanics of this works a lot better, is that the average household spends around 30 to 35% of their after-tax dollars to pay their mortgage. Now, if you have a 1% increase in interest rates, it has a 15% increase to the repayments. So therefore, they have less money to spend. So therefore, it puts a downward pressure on the type of property that they're willing to buy or they can afford. So a lot of economists are talking now that a 1% increase in interest rate will most likely have a 20% change in property prices. Now, whether it happens this year, next year, or in 2024, we as a fund need to always be thinking at forefront of our mind to make sure that we preserve our that our investments are cushioned for any economic shock like that.
And look, we're aware of it. We know it's going to happen, as you said. But look, let's look at history. The biggest drop in asset prices was basically in 2017 when APRA came in and put the brakes on.
Yeah.
Now that dropped asset values, let's call it 10% for round numbers. If you're looking at national, if you look at mortgage investments, where we said before, where we're generally not gearing more than or lending more than 65% of the asset value. So if we've got $1 million property, we're only lending $650,000 against that property. For our investors to lose money, the asset prices must drop 35%. Now, that is why we can, with certainty or with clarity, understand where the market has to go and where we can actually manage our own risk.
And also, it gives the ability for our investors to make those decisions themselves as well. So we will go and find opportunities that are better suited in the current market that will be cushioned if that type of event happens. Remember, mortgage funds do very well when there's a lot of volatility in the market. The reason being is that we need to continue to ensure that investors are continuing getting their regular monthly income. That is very, very critical.
Well, let's talk about, you need to also cushion for a black swan event. We've just recently mentioned one, which is a big one, which was COVID. Now, our investors told us they loved our sector because we were paying them monthly every single time, and they could live off that money. When other shocks happened where they were losing income from other sources. So we are a defensive business. We like saying we're not sexy. The word sexy can have different connotations, but we are very simple in that we return our monthly mortgages, our monthly income, and we are defense for those type of events.
And it's very important to actually assess that you have the traditional funds management fundamentals is that you have a 60-40 split. So it's part of your diversification is you need to ensure that you have certain amount of your money that is very can cushion and doesn't have any volatility in it. So when things do get volatile in the marketplace, like for example, shares can go up and down, but you're still having your regular income that you can live off, and you can take opportunity in the marketplace in other asset classes when the time is right.
So we're saying we're one of those alternatives in that space. So now we've discussed what we can't control. We need to understand what we can control when we're actually investing into direct mortgages.
That's right. So when you're looking at a direct mortgage, you need to look at a combination of things to assess the risk. So you look at character, capacity, cash flow, competency, and most important, collateral as well.
So not all mortgages are the same. They have different risk, and it's up to us to provide our investors an understanding of what that is so that they can manage their risk. So the best way to do that is to show you a recently settled investment that we did. So you can see how we went through our credit assessment process. So we had a borrower come to us. It was a targeted return of 6.75% for net to our investors. It was an 18-month tenure. We're only lending 65% of the value of this petrol station, and it was a first registered mortgage. The first aspect we look at is collateral. So in the unlikely event that the borrower cannot meet its obligations of paying interest to us, what as a business do we fall back on? And we fall back on the asset being the service station. Now, the service station, importantly, was in a blue chip area in New South Wales in Strathfield. It had a Woolworths lease guaranteed by Woolworths. What else?
And if for any reason the tenant would walk away from the property, the valuation of the asset was higher without the tenant than with the tenant, because it could have been a development site. Now, look, for purposes of our assessment, we applied the lower valuation, which was the service station.
I think importantly as well, everyone should understand that we get sworn valuations by panel valuers every single time, so we can assess the value. We also have internal smarts in the business where we assess valuations. The next step is character.
Absolutely. Look, this particular borrower has borrowed from us previously before, and other banks as well. He has an impeccable repayment history. He's actually known for always paying on time, never having any issues. He's a known individual in the community, very well respected. So from that perspective, we've done all the searches. We've known him very well, good character and record.
So that was a tick. The next one is capacity and cash flow. Now, it's very important that our investors get their monthly payments of we're sharing the interest income received. So distributions are paid monthly. So capacity and cash flow is imperative because that borrower needs to be able to make that interest payment. So in this instance, we had a strong lease, but importantly, there were other aspects of income from these assets and liabilities that could shore up if there was a shock. So we always assess in this instance, if something happens, how is the borrower going to be paying or meeting the obligations? And this instance,
which is very important because in the history of our fund, we have never missed an interest payment for our investors. And that's what we're looking for. We're looking for that capacity and cash flow to ensure that he can pay every single month.
The next one is competency, Paul.
Yeah, competency. Well, look, what you're looking for is a person who's competent in that particular profession. He's a professional property investor who's done very, very well. He's run other businesses as well, very well. And we're looking for that competency. You don't want to be lending money to someone who's doing something for the first time.
So look, in summary, Msquared provides you with the opportunity to be in control of your direct mortgage investments. We provide our investors with market-leading returns, which start from 6.5% net to the investor. Importantly, we stress collateral. We are always secured over property in the eastern seaboard of Australia.
We also provide an ability for investors to receive information and due diligence on every single opportunity. And they also have access to us, who are more than happy to discuss each opportunity and how we can construct the right portfolio for that particular investor.
And I think it's important, Paul, that some investors just want a higher level summary. Others like to look at the detail. They like to look at the valuations. They like to see our market commentary, and we provide all of that. So how do you become part of the team? How do you get to feel the investments? Well, there's only one way. Please go to our website, www.msqcapital.com.au. It will appear on the screen. Follow the prompts and submit your details. Alternatively, it's very easy. It's Paul and Paul. You can call us anytime. The number's on the screen as well. We'd love to speak to you. Thank you very much for your time.